What if I told you that a stock market crash is just around the corner? Very unexpected, right? Warren Buffett is aware of this impending dilemma. Nevertheless, are you aware of the best solution to this issue? Wait while we go into more detail about this in the video. First off, Warren Buffett agrees that there is a serious situation that cannot be undermined and does not rule out the possibility of a stock market crash and depression. He discusses on the scene of how the Dow declined from $1,000 to $179 in less than 24 months, using the incident of 1929 as his point of reference.
The 1929 crash, which led to the Great Depression. And here, the Dow Jones average, which we'll use through this, at that time, that's the one everybody paid attention to. Actually, the second most important average at that time, if you look at the papers, was the New York Times average, which has disappeared, and of course the Standard & Poor's.
That is a substantial drop, right? Ironically, reaching its previous high took over 3 decades. Additionally, he claims that people in those days did not have a growth mindset and believed that whatever was going on at the time was a recession rather than the Great Depression. The reporter wanted to know if we should be ready for stocks to lose 80 to 90% of their value, which led to an intriguing question from the interview. In response, Warren Buffett said that he does not know what will be at stake tomorrow, and that it is still a mystery. Warren Buffett's strategy of buying shares in large firms when their values are relatively low has helped his company Berkshire Hathaway to achieve a substantial profit of more than $23 billion in just over half a year. From this, he gives you, as an investor, a cause to anticipate a lower stock market. Second, Warren Buffett suggests that as the world continues to evolve, different businesses must adapt. He was asked at a conference if adopting change was necessary if stake ownership did not conflict with the goal of making profits. With his pearls of wisdom, Warren Buffett explained the need to sell if the situation changes, using the Keynes theory.
Keynes wrote about this in 1936, I think it was, in the General Theory, or 35, I think it's chapter 12. It's a great chapter on investing. And he talked about investment and speculation and the propensity of people to speculate and the dangers of it. And worded eloquently, there's always the possibility of, there's always some speculation, obviously, and there's always some value investors and all of that sort of thing in the market. But when speculation gets rampant, and when you're getting what I guess Charlie would call social proof.
Also, he provided an example of how he sold all of his company's shares in American Airlines, which included Southwest, Delta, American, and United. Everything changed after he initially paid $8 billion for the 4 firms, which compelled him to sell the holdings for $6 billion. He rotates his slogan about taking all necessary precautions and not compromising any situation if he changes his mind. He thought it would be preferable to accept the loss of $2 billion like an adult, rather than cutting the solution and adding to the expense. The primary driver behind this decision was the government's numerous loan bailouts, which would have required him to dig deeper into his wallet and spend his wages to pay off debts. Also, he saw individuals being told not to fly, and all of this combined to create a toxic environment for him, pushing the shareholder to pursue an exit strategy. After giving it some thought, why buy a company only to suffer losses that force you into bankruptcy? It does not seem logical, does it? You would rather sell the business completely at a loss to avoid a crisis and invest the proceeds in a profitable venture that will make up for the money you lost. In general, this was a win-win situation for Warren Buffett, and if you do not resist change, it might be a win-win situation for you as well. The final warning sign from Warren Buffett is that there will likely be many instances of stock market crashes in the future because of a potential pandemic. He'd exclaimed that we should be ready for future market crashes and that recovering from COVID-19 is not the only way to prevent them. This is actually a little scary, as the COVID pandemic has been replaced by the Russian-Ukrainian war on the podium. While Warren Buffett claimed that fear could occasionally have a greater impact, we are currently seeing how the Knight Corporation is struggling to balance its accounts despite experiencing a 65% increase in sales. Warren Buffett still believes that fear plays a role in stock market crashes because it causes people to act hastily and unreasonably when they are frightened. He said that because they had managed to survive the ups and downs for so long, he and his buddy, Charlie Munger, had never experienced financial fear. In conclusion, it is important to remember that fear has the capacity to trigger a market rapture, and that there are moments when it is necessary to overcome your fear in order to succeed.
Stock markets.
That's a very tough problem. Some people can control their emotions and other people cannot control their emotions. And unless you can control your emotions, you're probably not going to do very well in the stock market. I happen to have a certain temperament that works pretty well, and that I don't get excited because other people get excited about things, and I don't get depressed because they get depressed. You have to be able to form an independent judgment and not let your emotions take control.
But I think it's very hard to practice.
It is hard for some people to practice. It's hard for many people to practice.
Fourth on the list of warning flags is the company acting pricey, even though its real value is lower, according to Warren Buffett. In order to maintain their value even when the markets drop, corporations often bootstrap value into the business. Because they made several lump sum investments that may handle emergencies, the crash will not have a bigger impact either. Due to overpriced equities in March 2020, Warren Buffett decided not to purchase anything, claiming that none of the stocks were interesting and the prices were absurd. In general, try not to be too hard on yourself if you cannot match the price of investing in a particular company. However, spend some time analyzing the firm's absolute worth. We all want to spend money where there are reasonable prices and certain rewards. Another cautionary statement made by Warren Buffett, this time in reference to the coming stock market crisis, is that you should expect the unexpected to happen. Strangely, he backed up this claim by adding that no one should gamble against America in an interview with CNBC. In general, this indicates that the odds of winning in the market can change at any time, taking into account the previous economic downturns the United States has experienced. He reveals that people are conceited to believe they are invincible while, in reality, they are unaware of the implications that their egos bring. Additionally, because they eliminated the worst-case scenario, they will be unable to come up with a real remedy if the stock market crashes. He worries, nevertheless, that people have not yet applied what they have learned from the last pandemics to get better and act morally, which illustrates why many people lose in a situation like this. Finally, are you aware that difficulties might make you stronger? Warren Buffett underlines that the coming financial crisis will be the ideal opportunity to borrow money. Does Warren Buffett advise you to take out large loans then? Practically speaking, he suggests choosing loans with low interest rates, rather than taking out expensive credit card loans. For instance, despite having $130 billion in cash, Berkshire Hathaway borrowed money to exploit.
Lifetime, an index fund would do 11%. Well, imagine how you'd have done if you'd leverage that up 50% at whatever the prevailing rates were over time. Leveraged investment in a business is going to beat an unleveraged investment in a good business a good bit of the time. But as you point out, the covenants to protect debt holders have really deteriorated in the business. And of course, you've been in an up market for businesses and you've got a period of low interest rates. So it's been a very good time for it.
He described how the credit market came to a stop in March 2020 in relation to this. But the Fed had stepped in and slashed rates and liquidity. They used the relaxation to expand their financial base as a result. Another instance of how Warren Buffett profited from the financial crisis was in 2008, when he struck deals with illustrious businesses like Dow Chemical, Bank of America, Mars, and Goldman Sachs. For instance, he predicted the impending collapse of Goldman Sachs and took an opportunistic initiative to save the company by coming up with a lucrative proposition that was difficult for the management to turn down. He was given an additional 15 billion shares as a warranty as part of the agreement. He approached Mars using the same strategy and made a huge profit of $680 million. That was a fairly wise decision, right? This implies that even in difficult economic times, there is always hope, and that we should continue to seek out competitive advantages. Speaking of opportunists, one man followed Warren Buffett's advice and worked his way up to make $1 million from a $1,000 investment. In 1953, while the United States was experiencing a recession, the late Russ Grimmel made the opportunistic decision to create a business plan. With that being said, that's all for this video. Let us know your opinion in the comments section. Do not forget to hit the like and subscribe button for more trending topics on the global stage of economics. Click the notification bell so that unique content does not pass you by. Thanks for watching.